Okay, we're going to quickly move on to growth alternatives. So if the panel could come up, we have got Kieran hosting this panel and he will make those introductions on these alternative gurus.
That's great. Good afternoon, everyone, and thank you for having us. Fred's going to join me and then on stage, and we have Alex going to join via video link, hopefully soon, out of Hong Kong. So just a quick introduction before we start going through our talk for this afternoon. Fred Pollock is the Chief Investment Officer, has joined me here from GMC Grosvenor, a firm that we've dealt with on our side for many, many years. Fred is head of the Strategic Investments Group, also sits on all the investment committees, including also the Diversity, Equity and Inclusion Committee and ESG and Impact Committees. And prior to joining Grosvenor, Fred was with both Morgan Stanley and Deutsche Bank. He also received his Bachelor of Science summa cum laude in economics from University of Nevada and his Juris Doctor magna cum laude from Harvard Law School. And then joining on screen, I think, if we have him, I'm just checking that we do have there, we have Alex Chambers, Vice President and Director of Alternatives for Wellington APAC. So Alex leads the engagement with their clients and prospective clients across the group's alternative platform through a range of their hedge fund strategies. Prior to joining Wellington, Alex was previously an Executive Director with the Mann Group in Asia and in London. And Alex earned his Bachelor of Arts in Classics from the University College in London. Hi, Alex. I think you're there. That's fantastic. So to start off today, I'm going to have a little bit of a discussion with you. I'll get past our disclaimers and introductions. The case for alternatives, we're looking at it from a portfolio construction point of view. So within the Findex Group, I sit as Chief Investment Officer. We run about $10.5 billion in managed discretionary accounts. And really, we've since about 2015 worked on our own alternatives program. So some of the reasons why we see alternatives as being so important in our portfolios. One, going forward from now, is reduced expectations on returns, both in the defensive and also in the growth asset classes, the traditional asset classes. And then there are also times when we see quite often that equities and bonds are more correlated. We saw that in 22, we've seen it in other times as well. We could see it in a situation where there's stagflation, not that we think that that's highly likely, but it is a possibility. Also for us, getting diversifiers into the traditional portfolios, which is your traditional, for example, balanced 60-40, especially as we look at potential recession going forward. And also we look at the S&P 500, some of those things there, we look at the valuations, they seem priced for perfection. So there's some good reasons why we want alternatives. And I'm going to run through mine pretty quickly because I want Fred and Alex to talk about what they do for us. So we treat alternatives as a distinct asset class. Some of the things and some of the characteristics that we're looking for in our programs, one is the ability to short. We look at something when we look at most of the strategies being absolute return focused, so more focusing on performance and volatility objectives rather than outperforming specific benchmarks. We look most certainly as a portfolio defensifier with a lower correlation to the major equity and bond markets. Flexible strategies that are typically not constrained by markets and strategies, etc. And then very definitely in our clients' portfolios, and I think in most retail client portfolios, a lot of our clients are older. They don't have time for recouping any major capital losses. So downside protection is critically important for us. And we put great emphasis on that low volatility and capital preservation. The bottom line for us is that from our perspective, the alts universe and the ecosystem that alts sit in is vast and complex. And managing an effective mandate in this ecosystem is very, very difficult. You need significant resources and you need expertise to do that. So from our perspective, what we wanted to do is find the best partners we could partner with that could actually manage a mandate. We didn't want to be selecting individual funds. We didn't want to be monitoring individual funds. We wanted firms that could actually help us put together a mandate and then continually run that mandate for us. And you'll hear shortly from both Grosvenor and Wellington that have done that for us. But maybe just a really quick example to how we've seen the performance in our growth alternatives, which is run by Grosvenor for us. So here we're looking at the drawdown series. This fund was brought in, we seeded it in, I think it was December 2018. So if we have a look there, you're looking at the Miski Acqui drawdowns since 2018 to date in the black. So you'll see the drawdowns there, and you'll see how the fund has performed in those exact same periods. So what you can see in there, there's definite downside protection that did very, very well through COVID. This helps to dampen volatility. There's great diversification and correlation benefits that are in here. Just another way of looking at that same example is looking at it here on a relative experience. Also, Miski on the drawdown, those drawdowns since 2018, 22 out of the 24 months where there were drawdowns, the alts program performed extremely well. So it outperformed. You can see the relative performance there. It had 2 months where it was negative, but the rest was extremely positive. So that gives you just a bit of a sense of how alts have performed for us, being run by Grosvenor and also by Wellington. This is just a quick overall view of the program since inception. It gives you a bit of a sense. We incepted it in a retail product because we needed it for our clients. Clients are on platforms, etc. Top right is probably the most important graph there. You can just get a sense of how that graph, how the fund has performed. We do use a reference to the HFRX market neutral index. It's not perfect for the fund, but it's as close as we can get for that fund. And you can see the actual performance bottom left. So that gives you just a bit of a sense for us within Findex. Alts are extremely important, both on the growth sense and on the defensive sense. They play a very important part in our portfolios, but probably most importantly are the guys within Grosvenor and Wellington. So I'm going to welcome up here Fred to come and talk a little bit about Grosvenor as CIO. What do they do? How do they do it, etc. So Fred, welcome you to the stage and hand over to you. Thank you.
Thank you. Is this on? Can you all hear me? Okay, perfect. All right. So you all heard where I went to kindergarten, which is great. In the introduction, you got the full background. Just a little bit about who Grosvenor is. So we're a 50-year-old plus firm. We exclusively focus on alts. So when you think about what this is, hedge funds is one category that was discussed in terms of what we do. You'll see on this sheet in terms of other categories, real estate, infrastructure, credit, as well as private equity and sort of sustainable investments across the board. We manage about $80 billion US today. I think the slide's a little bit old. Of that, $23 billion is in these absolute return strategies or hedge fund strategies that we'll talk about a little bit later. Important figure on here, 71%. So most of the capital that we manage are in large custom accounts for very sophisticated clients. So if you think about who these are, sovereign wealth funds, insurance companies, in some cases central banks, all sorts of different groups in the world who are interested in accessing alternative investment strategies but want to do so in a very diversified and kind of planned manner. We have 539 employees. I manage 176 investment professionals around the world. That's everywhere you can imagine. So emerging markets, London, the US, et cetera. And we cover all these different strategies and we're pretty deep. So when we get time to questions, if anybody has any about kind of anything, I'll tell you based on the last one, I have no idea what interest rates are going to do. I don't know what the stock market's going to do. And it's not how I don't think that's how anybody makes money, but we certainly don't make money that way. We try and harvest kind of alpha over a period of time in each of these strategies. Quick little bit of credentialism about what we do and how we work. So Grosvenor is a complex animal. So of that $80 billion, a lot of it is out in the world in what we call primary investments, which are fund investments. So we are invested in every kind of high quality fund in each of these categories that you can imagine. It's hard to get on that list. So we spend a lot of time kind of vetting, talking with managers. We've been doing it for over 50 years. In many cases, the managers are closed. So, one of the challenges actually in our space isn't that it's hard to discover who's a good manager. Like we all know, for example, in hedge funds, Citadel is a good manager. good luck getting invested, right? If you don't already have capacity and you're kind of been there for a long time. So, and in some of the cases, we've been there for 30 plus years, a lot of these examples. So it's not always just knowing what to do, it's being able to even implement that. That's very, very important. We track everyone. So meaning of the universe of managers that we're invested in, there's a little over 750 in total. We track a little over 6,300. The other things we do, you'll see in these little graphics on the right of this slide, you have to add value in other ways over time. So we started doing co-investments probably 30 years ago. We make direct investments, so we run our own hedge fund, we run our own credit funds, we run pretty much every strategy directly as well, sort of competing with the external providers that we could provide capital. That's actually the fastest growing part of Grosvenor today, so it represents kind of about 30 billion of the 80 billion is in that category. We do secondary transactions, buying things out in the market, and we seed. So we help actually get funds launched and off the ground in a lot of different categories over time. That can be very interesting, obviously, because you can earn excess return off of that management fees and performance fees associated with the managers themselves. I always give this stat because people wonder kind of how connected are you. Grosvenor spends about $4.5 billion a year in fees globally to the underlying managers, if we give you some sense. So we're part of the ecosystem. We are an asset manager. We obviously collect fees, but we pay a lot of fees to different managers. We have to produce alpha in excess of that. Obviously, we wouldn't add any value or utility to the clients. And so I think it's a pretty good sense that we're in most of the categories where there's interesting things going on because we have to kind of out-earn that substantially. Just a quick, in terms of what our capabilities are, I'm going to later drill down on the green one, which is the absolute return strategies kind of bucket. The others you can sort of see, I won't read each of these, but you get a sense of we're large in each of these other kind of core categories. So absolute return strategies, it's a code word for hedge funds. Hedge funds doesn't market well anymore in the globe and hasn't marketed well for like 25 years. So now it's absolute return strategies. That actually is somewhat fitting. I mean, the fastest growing category in the hedge fund space or absolute return strategy space is actually multi-managers, which in some cases are hedged, in some cases they aren't hedged. I'm talking about Citadel, Millennium, Point72, kind of all of those firms. They now represent half of the category. So to give you some sense, everything else in the hedge fund space really hasn't grown for 20 years. That category grew from almost nothing to representing half of the whole and still kind of growing overall. The other things I'll mention here, credit is part of this universe, although credit obviously has its own world now too. So you sort of seen on a prior sheet that we had a vertical in credit. That's outside of the absolute return space, and so we obviously cover both of them actually quite well. It's very, very important you have people on the ground. So, one of the things Kieran asked was given examples or try and bring to life exactly what you do in terms of the work. We know everyone. So we know everyone down to the people who sit in the desks, who are doing the investing at each of the pods or each of the firms. We track them over the course of their career. We know the operational capabilities of each of these firms. We have people and ourselves on the ground in each of these areas trying to track them. And then, we ourselves are investors in the category, know how hard that is. Like if you listened to the panel before, one of the things I could tell you, it's hard. What they're all doing, trying to produce alpha every day. The industry as a whole produces negative alpha, right? Just think about that for a second. The fees are larger than the alpha that the industry produces in the asset management space. I'm probably not supposed to say that at this conference, but I'll say it anyway. It's true. So if you looked at the average, and there's some logic to that, right? You have a lot of distribution costs. Everybody wants to be above average, so everybody chases managers, and probably the industry overproduces volume in terms of asset management services, versus the utility. We have to know everyone. We have to find the ones who actually produce alpha, and they're going to do it sustainably, kind of over a large period of time. I think we do a pretty good job of that. So when we get to kind of questions or anything else, I'm happy to try and dive into that a little bit more. Here's the basic strategies or categories that we're talking about. So when we say we produce, alpha, what do you really mean? You're trying to produce 2 to 5% excess return over a long period of time in the hedge fund space. You're trying to do it in a diversified manner. So our typical portfolio, 30 to 40 funds. If we're talking about a co-investment portfolio, 50 positions. If we're talking about direct investing, more, even more than that in each of our categories. You're trying to do it through all the cycles, which is not an easy thing to do. So when COVID strikes and you don't lose money, that's a success for us. Not the easiest thing to do. It requires a lot of relationships, a lot of access, kind of a heritage and working with the right people. It's a credit to the individuals we provided capital to over that period of time, is what I would tell you. The other thing I'll flag here, these names are a little bit conventions, the shorthand for trying to explain the strategies. There's probably 100 different hedge fund strategies that are relevant today. It's not kind of 9 buckets, but you can sort of see what we have the traffic in otherwise. So I'm going to pause there. I'm trying not to use up all of the time, and I want to give Alex a chance to go, and then we'll obviously take questions.
That's fantastic. Alex, I think you can come on. Would you be able to share your screen for the slides if possible, Alex?
Sure, let me do that now.
That's
I
great.
hope you can hear me okay.
Thank you so much. Thanks.
You can hear me okay? Just checking.
Yep, that's working.
Okay, great. So good afternoon, everyone. Thank you very much for the opportunity to speak. Thank you, Fred, and thank you, Kieran, as well. So a bit like Fred, I'm just going to spend a little bit of time talking about what Wellington is, if you're less familiar, what our hedge fund platform looks like, and then talk a little bit about multi-strat investing, how we think about building multi-strat portfolios like the one we've done with Centric today, and why we're really excited about the environment today for long-short investing. I don't have a lot of slides, but just the next couple of slides just talk a little bit about what Wellington is and who we are and what we do in hedge funds. And so for those of you in the audience who may be less familiar with Wellington, we are one of the largest privately owned asset managers in the world. We have about $1.2 trillion, so a very large asset manager. I normally like to start by saying, when it comes to our hedge fund business, 2 key facts to take away. One, we've been doing this for quite a long time now. You can see in the heritage key dates in purple, our first hedge fund launched in 1994. So actually in February, we celebrated our 30th birthday doing long-short investing. And secondly, we're a pretty big manager in the space. You can see in those statistics in the slide, $36 billion in alternatives. And if I shift one slide, a large component of that alternatives is in hedge funds or liquid alts. Today, about 75% of our alts business is in liquid alts or hedge funds. And we have a very broad client base. Today, we have roughly about 1,200 plus clients across the globe. In terms of what we think of our hedge fund platform, we really like to think of ourselves as a platform of boutique hedge funds. We don't have just one hedge fund strategy or team. We have many, many different hedge funds. We think that's quite unique for a hedge fund manager. As you can see from that pie chart, we try and cover the real broad base, even though it's quite top down here. We have a lot of different hedge fund styles. If I was to put a number on it, we're probably around 80 individual alpha streams or risk takers within our platform, and probably around 20 to 25 actual hedge funds that clients can invest in directly. So we are very broad-based. The other thing I should point out is that our hedge fund platform, it's a wholly owned platform. It's internally managed by Wellington. And so all the hedge funds are part of the Wellington platform. And because we have all these different breadths, we can really partner with our clients like Centric to really build customized portfolios, which I think is very differentiated from a lot of other hedge fund managers out there in the space. Just very quickly, a little bit about what we think is our edge or our differentiating factors as a place for working as a hedge fund manager. There are 4 key things on the right-hand side we talk about. It is a talent game. You see this in the Bloomberg news all the time about the war for talent in the hedge fund industry and trying to attract the best talent. We have fortunately been able to hire some great talent from some of our peers over the years. But we've also focused on not just hiring talent externally, but also building the next gen of talent. We have our own seed platform or incubator, and we look to seed our own managers, younger generation, and help them learn how to do long-short investing. The other 3 factors I think are quite unique to Wellington, and we think is why we can attract the talent. Research to us is incredibly important. We have a deep centralized proprietary research platform at Wellington. We have about 100 people just solely focused on research, both bottom up and top down. And we think that's incredibly valuable as a PM for a hedge fund. The ability to tap into those 100 plus researchers and hear all their ideas is really attractive. Not surprising our scale. As a PM, you want to be focused on investing and generating alpha. And coming to Wellington, you get to benefit and leverage off all the execution, trading, technology, operations, compliance. And that means that you can just solely focus on what you're good at, which is generating alpha. And then finally, this one is always a little bit hard to articulate on a slide. We talk about our culture of collaboration at Wellington. This is something we think is quite unique at our firm. We really are a transparent firm within. Everyone gets to see each other's positions. Everyone gets to share ideas, whether it's long short or long only. And really, that's important to us. So everyone is not just sharing ideas, but they also challenge each other, debating with each other. And we think that makes our PMs much better risk takers and much more aware of the risks going on around the world. And so we think that's something quite unique to Wellington in the way we do things. Those are a couple of slides that just talk about our firm, just to then talk a little bit about how we think about multi-strat investing and what we worked with Centric in terms of how we build portfolios. Just like we did with Centric, when we think about building multi-strat portfolios, we start with a definition of what clients want. And for us, there are a couple of key things in terms of the objectives that we want to achieve for our clients. Firstly, we want to generate positive returns in a stable way and a consistent way. Secondly, we want to do it in a diversifying way with low sensitivity or low beta to equities and credit. And so it can be very complementary to other things in your portfolio. And as Kieran mentioned at the start, very important to us is the downside protection. We want our investors, our clients, to be able to sleep at night, not worry about this part of the portfolio. And so we're very focused on the downside and making sure we can withstand equity stresses of volatile markets. And so that's how we think about defining the objectives for a multi-strat. How do we do that? We're quite fortunate at Wellington. We have such a broad base platform in terms of different styles. And we're quite fortunate in the fact that we have very different roles to play with each different hedge fund team. So when we build a portfolio, the focus is on having as much diversification, having as many different building blocks with different approaches. And we're very fortunate in the fact that because they're all wholly owned by Wellington, the PMs for the multi-strats are able to really spend a lot of time with the teams, underwrite them, get to spend a lot of time understanding the positions real time, and really thinking about what happens intra-month in the middle of any stresses and how they react. And not only is that transparency available for us, but it's also available for our partners. And Kieran will know, and when Centric spent time with us, they spent a lot of time not just meeting the portfolio managers, but actually meeting all the underlying risk takers, getting to know how they run their portfolios and how they generate alpha. So it's this partnership approach that we really appreciate when we think about building multi-strats. Just to finish off, just a little bit about the environment. I've been doing hedge fund investing now for 20 plus years. I actually started in a fund-to-fund business, allocating to hedge funds. This is probably the most exciting time post-GFC I've seen for long-short investing. We really think it's a great environment for long-short. We talk about the 3 different Ds at Wellington in terms of the opportunity set today. We talk about divergence, we talk about dispersion, and we talk about disruption. Divergence, the fact is that global economies today are all moving in different ways, different monetary policies, fiscal policies. We saw Europe cutting this year already twice. We've seen the Bank of Japan raising rates. So we're in a very diverging economies today. We think that's great for long-short investing. Secondly, in terms of dispersion is back, higher cost of funding. For stock pickers in our long-short space, we're really excited by the fact that now that some companies' share prices are moving on fundamentals. And finally, in terms of disruption, we're seeing these big mega trends, particularly with global innovation and technology advancements and AI, that's creating a large number of long-short opportunities as well for our hedge funds. So those are some of the areas where we're really excited and why we think it's a great time to be in multi-strat. I'll stop there and I'll hand it back to Kieran.
Thank you so much. Thank you, Alex. I've got a couple of questions for yourself and for Fred before we throw to the floor. So I think we might get 1 or 2 in. But Fred, I was going to start with you asking a question. You know, you guys are very complex. You're dealing with a lot of different managers. How do you differentiate and what do you guys do when you're looking at managers from an investment thesis perspective? And then also because these managers are so complex and how they operate, their governance is quite complex. What do you do and how do you look at it from their ability to execute their operations and their governance? And how do those 2 things play out within Grosvenor?
So that's a good question. We have a dual track process. So basically you have to get an investment approval, but you also have to get an operational approval. And none of the people sit on each of the sides, if that makes sense. So we have plenty of examples in the history of the firm, like Madoff is a good example. So, you know, it was rejected basically from an operational perspective. The investment returns, if you had just looked at the returns at the time, you would have been potentially excited to invest, but you would not have, when you kick the tires, decided you want to put capital there. So, and we do that across the board. So, and there's a lot of different reasons. I think if you went back into the early 90s, it was mostly about fraud. I mean, that's the major reason why this process kind of was created was, you would find when you do a really deep operational kind of due diligence dive that there are just frailties, in the process and the systems and the reporting and otherwise that could be represented. And the hedge fund space is kind of replete with examples of these. It's obviously a space where, if you could fabricate returns for a couple of years and amalgamate capital, you could, so to speak, pay it back. You could kind of go to the piggy bank and you just under-earn for a couple of years and you got fabulously wealthy through that process. So it was vulnerable to it. And then we extended that process to every other category of investment. So they're all different depending on where you are, like private equity. The operational due diligence is very different than obviously for hedge funds, but they're each critically important in terms of being able to make the investments. And I think it's become essentially industry standard now. I would argue we maybe pioneered it probably, back 40, 50 years ago, but it's kind of standard across the board now.
Thank you very much. That is one of the things that stood out when we first met with Grosvenor was that dual track process, really incredible process. And maybe Alex, from your side, I guess you guys are a little bit different that, your platform is in-house. Do you see, how would that, how would you compare and contrast that and the advantages that you guys see from that perspective?
I think from an in-house perspective, and I also worked for a fund of fund before that, so I see the pros and cons of both sides. For us, it's having really being able to underwrite our underlying risk takers, and firstly, they sit in the same building. We know that they're part of the firm. We know exactly what they're doing day in, day out, and we know how they're going to react to different market environments. So that's the first comfortable part of an in-house multi-strat. I think the other thing which is really valuable, and maybe there's an example to articulate that, is the fact that we're sitting on this much bigger asset manager with this big research platform, and that we have the macro people and we have the micro people, the top down, the bottom up, all sharing ideas. And sometimes people start to hear concerns or ideas or risks that may be outside of their focus point. And so I'll give you an example. Last year, we got on quite quickly to some of the stress that was happening in the regional banks in the US back in Q1. If people remember back in March and when some of the regional banks started to get under stress. And it was actually our financial long-short teams who are looking at the bottom up and looking at the banks who had picked this up quite early. And that's actually part of a lot of our multi-strat portfolios. And not only did they see that and took advantage of that, they started to share that view across the firm. And then the macro teams who are looking very top down, they wanted to learn more about this and could this become a bit more of a global issue. And as a result, they were able to quickly adjust their positions in mid-March and take advantage of that change in the stress in markets in the second half of March. And so that's what we think is really valuable, the sort of internally everyone working together, sharing ideas, sharing different perspectives on the world from a macro and a bottom-up perspective.
Excellent, thank you. We've got a couple of minutes left. Might just throw to the audience. Toby, I don't know if we've got any questions from the audience.
Francie? Jenny's got it.
You both talked about the talent acquisition that you've done and the investment processes that you do, but part of both of your presentations was the reliance on your platform and the technology. Can you both comment on the spend that you do to maintain that, to keep to keep this engine going?
Sure, I can go first. So kind of across our ecosystem, if you look at, people would spend billions of dollars accumulating the data each year. So some on the underlying funds, like let's give you an example. Citadel spends more than $1 billion a year, just as an example. And it's whether it's technology, whether it's the data that they're collecting, particularly the quantitative oriented strategies would be the most capital intensive from a kind of data and operational perspective. That is their edge, right? To the extent of, and it's not spent the way people think. It's obviously subscriptions, culling data. It's the cleaning of data to make it functional that is extremely expensive, right? So that you can be able to run models across it. But so it's a ton. And then, internally, we probably spend hundreds of millions of dollars a year on all sorts of different, technological, kind of innovations related to what we do. A lot of it's portfolio construction. So I don't know, Alex, if you want to comment.
Alex?
Yes, I agree. In technology, I wouldn't even have a specific number of how much we spend, but in the hundreds of millions, I'm sure, as a firm. It's very important to us to be able to have our PMs have access to the best technology there, particularly in terms of risk management, analytics, portfolio construction, even trading execution. But I would not just discount the other side of the coin the research and the fundamental analysis that we really value here at Wellington. So it's a balance of the two, and it's not just the technology that we're focused on.
It's great. Thank you guys so much.
Other questions?
Any other questions?
I just have a question with regards to artificial intelligence and how your underlying managers are using that, if at all, to get additional insights, extra insights.
Yeah, I mean, look, maybe I'll go first. It's a complicated one because even what artificial intelligence is, we could all have a debate about where the stage is. People have been using machine learning and other kind of advanced ways of culling data and building models on it, which they themselves produce the insights. Like if you really sort of step back, what was the first innovation? It's really machine learning, 15 years ago in hedge funds. And what was that really about? It's the idea that we historically, you have a thesis, you look at the data to test the thesis, and then you go back, and that's how people started just letting the data speak. So they would instead run models on it to try and see if there were there's things that were there that maybe could present themselves and be tradable. Like a perfect example, Renaissance Technology, one of their very early models back in the 80s that they were successful was weather. So they found that there were stock market anomalies associated with the weather. It doesn't work anymore, which is why they wrote a whole paper and publicized it, and they'll give it away to you because they can't make money on it anymore, but they thought it was a cute one to explain. But basically, like on sunny days, the stock market did better than on rainy days. It was a simple thing. It doesn't happen anymore because people traded that phenomenon away. So it's been happening kind of forever. I think AI is just the next evolution of that. I haven't seen anyone do anything particularly intelligent with it yet, to make a ton of money. I'm serious, I spend a lot of money, and there's a lot of people trying to, create models around it, and they want to be at the cutting edge of that because if you get there, you'll make a lot of money if you're there early and you kind of figure it out. But I haven't seen anything brilliant yet. The machine learning path is replete with it. There's a lot of quantitative trading associated with that, but it'll happen in the next 5 years. And there's, I can't say, like pretty much everyone trading stocks and credit is trying to figure it out, right? In terms of being the first. And I don't know yet who will do it. Hopefully somebody we've invested with will actually figure it out, right?
And Alex, from your side?
Yeah, I must admit for us, when it comes to AI, we're probably more trading the theme rather than actually thinking about internally. We obviously are embracing AI in terms of how we can be more efficient in our firm, how we can focus on the areas where we need to focus on and let AI enable us to do that. But upfront and honestly, I think where we're really taking advantage of AI is where the companies are going to win or lose in that space rather than actually trying to use it for models, or we're not really more focused on the quant systematic side ourselves. So really looking for the winners and losers in the space of AI.
Fantastic. Thank you so much, and thank you, everyone.
Kieran, I've got a question for you rather than for our two panellists, which is, by definition, these strategies are uncorrelated to markets. And so how do you incorporate their strategies, which are, what I've taken from this is evolving continuously. How do you incorporate those into your mainstream portfolios, the balance, the growth, and so on and so forth? How do you model the sort of exposure and the risks into your main portfolios? Kieran, yeah.
Okay, so one from us.
Yeah.
So look for us, Toby, when we're looking at this from our perspective, we've brought in two specialists. We want to look at it at more macro level from an SAA perspective and then a TAA perspective as well. So for us, it's trying to get that balance of what I've spoken about, which is the diversification benefits of the alts programs in there. You'll see in the slides, you can go back and actually have a look at the definitions of those and what the exact parameters are that we're looking at. So getting someone to manage those for us in such a complex environment is super critical. We also then have a look at it from a tacticals. We do strategic asset allocation, which is our medium-term anchor, and we'll do that. I think we'd reset ours last time in October 21 for a rising rate market. And then we look at tactical as well. So from a tactical perspective, when we're dealing in alts, very often they are less liquid. We've managed to get both of our programs to monthly liquid alts. And it's not easy to do that, but you can do that. But what we typically do from a tactical, because they tend not to be as volatile as what we see in equities and bonds, is we don't rebalance them throughout the year. So we typically would do quarterly rebalancing, or if we have got an intra-quarter TAA, DAA type decision to make, we wouldn't be rebalancing our alts. So we have quite a wide range in alts. We changed that to about 30% in a balanced portfolio. That is the range in alts. Typically, we would allocate to about 20%, and then we would leave that 10% for it to run up and, if necessary, come down as well. So that's how we're looking at it from an SAA TA perspective. But then it's really sitting with people like Fred and Alex as well to make sure that those programs can deliver the underlying into that strategic allocation so that we get that coming through in our model portfolios. So hopefully that answered that for you, Toby.
Thanks, Fred.
Thank you so much. Thanks, everyone. Thank you, Fred. Thank you, Alex.